Welcome to Unlocking the Upside, the podcast where we decode the mental models behind great investing. I'm Jeff Robinson, founder of theinvestmentanalyst.com.
And I'm James, ex-buy-side analyst, here to keep Jeff on track and challenge some of those long-winded market metaphors.
Today, we're talking about quitting. Yes, quitting. Annie Duke's Quit flips the script on perseverance and shows us why strategic exits are crucial in investing. Let's get into how that applies to stock picking, risk management, and portfolio design. Here's something that challenges everything we believe about success. Studies show that strategic quitters actually outperform persistent investors by up to 40% in long-term portfolio returns. The secret? Knowing exactly when to walk away.
That's a pretty bold claim that goes against everything we're taught about perseverance. What's the thinking behind this?
Well, it comes from Annie Duke's fascinating research on decision-making. As a former professional poker player, she discovered that the most successful players weren't the most aggressive or persistent. They were the ones who knew precisely when to fold their hands.
So how does this translate to investment decisions? I mean, poker is one thing, but the stock market seems way more complex.
That's where it gets really interesting. Duke found that investors often fall into what's called the sunk cost fallacy. Throwing good money after bad just because you've already invested so much. Her data shows that about 78% of retail investors hold losing positions too long because of this psychological trap.
That reminds me of what happened during the dot-com bubble. So many people kept holding on to those tech stocks, even as the fundamentals completely fell apart.
Exactly right. And here's where Duke's concept of kill criteria becomes crucial. It's like having a pre-written evacuation plan for your investments. Research shows that investors who set clear exit conditions before buying perform about 27% better than those who make decisions on the fly.
So what would these kill criteria actually look like in practice?
Let me give you a concrete example. Say you invest in a company because they're planning to expand into emerging markets. That's your thesis. Your kill criteria might include things like if they reduce expansion plans by more than 30%, if they miss 2 consecutive quarterly growth targets, or if regulatory barriers become insurmountable.
That makes sense. You're basically creating an objective framework instead of relying on gut feelings or emotions.
Right. And here's something fascinating. Duke's research found that investment teams who implement formal quit criteria reduce their average holding period of losing positions by 60%, while actually increasing their holding period of winners by 40%.
Those numbers are pretty compelling. But what about all those stories of investors who held through massive drawdowns and came out winning?
That's where the distinction between volatility and fundamental change becomes crucial. Take Amazon, it dropped 95% during the dot-com crash, but the core thesis about e-commerce transformation remained intact. Compare that to Kodak, where many investors held on despite clear evidence that digital photography was destroying their business model.
So how do you tell the difference between normal market noise and actual reasons to quit?
Well, successful firms use something called a pre-mortem analysis. Before investing, they imagine the investment has failed completely and write down all possible failure scenarios. Studies show this approach reduces decision bias by about 30%.
That's fascinating. It's like creating a diagnostic checklist for your investment's health before you even make it.
Exactly. And here's another powerful tool, investment journals. Firms that require regular documentation of both supporting and contradicting evidence see a 25% improvement in decision quality. It creates this ongoing dialogue between your past and present self.
Speaking of evidence, what about the psychological cost of admitting we're wrong? That seems like a huge barrier.
Oh man, that's such a crucial point. Research shows that professional investors hold losing positions an average of 3.4 times longer than winning positions, largely due to ego protection. But here's the kicker. Those who actively practice strategic quitting report 45% less stress in their decision-making.
That's a significant difference. How do successful investors overcome these psychological barriers?
The most effective approach combines systematic processes with regular team review. For instance, some firms have implemented what they call quit committees. independent groups that review positions solely through the lens of whether they should be exited. This has led to a 35% reduction in holding period for underperforming positions.
These numbers really make the case for strategic quitting. What's the first step for someone wanting to implement this approach?
Start with clear documentation of your investment thesis and kill criteria. Research shows that investors who write down their exit conditions before investing are 2.8 times more likely to actually follow through when those conditions are met. Then set regular review periods, monthly or quarterly, where you honestly assess whether anything has fundamentally changed.
This whole conversation really shifts how we should think about investment success.
Indeed it does. And here's perhaps the most powerful statistic. Portfolios managed with strategic quitting protocols have shown up to 40% less drawdown during market corrections while maintaining 90% of the upside in bull markets. It's not about avoiding losses entirely, that's impossible, but about making sure the losses we do take are strategic rather than stubborn.
Now that's what I call quitting while we're ahead with this conversation.
You know what? That's exactly the kind of strategic decision-making we've been discussing. When the value has been delivered, knowing when to wrap up is just as important as knowing when to begin. Before we wrap, here's something special. If you've ever wished investing came with a smart, interactive guide, well, it does now. It's called Insight One. Built from my decades as a top-ranked Wall Street analyst, this platform combines deep market knowledge with adaptive learning tech. Whether you're a novice or seasoned investor, Insight One delivers the same insights I've shared with institutional clients for years. Check it out on our site or download the app. That's Insight One, where experience meets execution.